Hey, everyone. How are you? And welcome back to our channel. Today, I have something special for you guys. I'm going to be going through some important tips and factors on how to get approved for a home mortgage. Yes, if you're a first-time home buyer or you are thinking about purchasing a home or you thought about it in the past, but you got afraid and you stopped the process, please watch this video to the end. I'm going to be sharing some valuable information with you guys, some valuable information that is needed for the process. Now, when I first purchased my home and I had to go through the process of getting my credit in order and mortgage ready, I was afraid. I didn't think it would ever happen. I thought that I would never be a homeowner. I thought I had too much student loan debt. I was just afraid. I had collections, I had charge-offs. But when I really started to take my credit seriously, I was able to get my credit ready in 60 days. Now, that's not for everybody. Some people can get theirs done quicker. Some people, it may take you longer, but I did have some resources in place to pay off a couple of charge-offs that I did have, because sometimes the credit restoration process can be lengthy. It can be long. And if you don't have time to wait, you're in a crunch to get a home mortgage, you may have to make some settlements to get some accounts paid off. That's what I had to do. So today, you guys, I'm just going to be going through and sharing some of that information with you. First-time homeowners, this is going to be good for you. I've been through the process, you guys. It's scary at first, but it's just like riding a bike. I've done it one time. I feel like I can do it again. And I think I can do it, in a breeze. So I'm going to be sharing some of that information with you. These are the topics that we'll be going through today. We're going to go through your credit scores. Have you ever have you ever checked your credit scores? Say on Credit Karma or Credit Wise or your credit card. I know some of the credit cards like Capital One, they have an app where you can check your scores. Have you guys ever checked your scores somewhere and then you went to a lender to get something, a car, a house, and your scores were totally different than what the lender saw? Today, I'm going to be showing you why and how to actually find the scores that lenders will see before you actually pull your report. We're going to be going through inaccurate and negative information, what can stop you from getting a home, as well as things that you can do in order to go ahead and get a home if you do have negative items reporting on your credit reports. We're going to talk about how to handle bankruptcies, defaulted student loans, and evictions, especially because these three things are going to be important when it comes to purchasing a home. We're also going to talk about your DTI. If you hear me say DTI, that's going to be your debt to income ratio. We're going to be talking about DTI and your credit during the process and what that means. We're going to talk about how your debt to income ratio impacts your credit. We're going to be talking about what it is. We're also going to be talking about how you can lower your DTI. The next thing we're going to be talking about is credit building, because whether you're trying to purchase a home, get a car, get business credit, whatever you're trying to do, you're going to need to have some positive accounts open and in place. And we're going to be discussing what type of accounts you actually need open and what types of accounts you need in place, because credit building is important. You can get negative items removed from your credit report and your credit score may not increase at all. Or if your credit scores are stuck under the 700s, I probably know why. It's just different things that you need to be doing when we're building credit. And at the end, if you catch this live, which you probably won't because this is going to be a pre-recording, there's going to be a Q&A at the end with your questions. You can just drop them below in the comment section, and I will do my best to answer each and every one of them, you guys. So if you have questions while you're watching this video, type them down there in the bottom in the comment section so I can get an answer for you, because I'm trying to make sure that you reach your goals of home ownership. That's why I'm going to share this information with you. I had no one to tell me or to help me through this process, you guys. My mom's not here. She wasn't here then. My grandmother and my aunt, they came to look at the house with me. But as far as getting my credit together and going through the process, it's just, I had to do it on my own, and it was hard. And it has become my passion to share with others what I went through. So other people can understand that if I did it, you can do it as well. So without any further ado, you guys, if this is your first time here, thank you for joining me. If it's not your first time here, welcome back. Thank you, thank you, thank you. You guys, my name is Jennifer Campbell. I am a credit specialist, strategist, educator, however you want to put it. My goal is to make sure that you reach your credit goals. That is what I do. I help people reach their credit goals. I am the CEO and owner of the Credit Laboratory. I have a bachelor's degree in business administration and finance. I was working on getting my master's degree. I'm actually 4 or 5 classes away from my master's degree, but I had to put it on pause for a minute to work on the Credit Laboratory, you guys. Hopefully I'll be able to go back because I have some other things that I'm thinking about pursuing. Earlier this year, I did go and take I think it was an 8-week or 12-week course. I can't really remember, on being a paralegal for a paralegal certificate. I do not work for a lawyer, so I am not considered a paralegal, just considered a legal document preparer. I cannot give any legal advice. Anything that you see on this video is for educational purposes only. I am telling you about my experiences and the experiences of my clients. You guys, I have helped over personally one-on-one since 2019. I have helped over 300 people, with their credit and trying to reach their credit goals. And I'll say a majority of them have been successful. The people who really tried and really wanted it and who really worked through the process, they got what they wanted. I've helped people get homes. I've helped people get cars. I've helped people start their business credit. I've helped so many people. I didn't keep count from the beginning, and I can't remember everyone's name unless I may see them on social media in front of their house taking a family photo or something, and then I remember. So, but yes, you guys, okay, moving right along. I've also been featured on Los Angeles Wire, Market Watch, Yahoo Finance, New York Weekly. I am not a guru, you guys. I just like to share my experiences with you. And I do have a credit company. And yes, we are accepting clients right now. And yes, I do help people DIY, do it themselves as well, through videos and education. And I do have letters available. And I'll leave more of that information down below in the description. Moving right along, you guys. First thing first, we have 2 different credit scores. The scores that we see on Credit Karma, those are going to be considered as our Vantage Scores. There we have different Vantage Scores. With your Vantage Scores, there are different models. There's a Vantage 1.0, a Vantage 2.0, a Vantage 3.0, a Vantage 4.0. Every time they update them. With your FICO scores, we have over 28 different FICO scores. But your FICO scores are going to be the scores that lenders use. Most of the time, if you're reviewing a free credit report, or sometimes even if you're paying for it, if you're not paying for it through myfico.com or credit.com or directly from the consumer reporting bureaus, which are the credit bureaus, from their website, you're not going to be seeing your FICO scores. Now, later on down, I'm going to be showing you how you can tell the difference between which score you're looking at every time you see it. Now, we're going to be talking about how your credit scores are calculated. We're going to go into detail between FICO versus Vantage. We're going to be talking about what is a FICO score. We're going to be talking about what is a Vantage score, and we're going to discuss what is it that lenders use. Now, Vantage scores are going to be different. They're going to be for educational purposes. Your Vantage credit scores are going to be those scores we see on Credit Karma or CreditWise. When you go to the bank, when you apply for a home, a credit card, or anything like that, lenders are going to be using your FICO scores. And if you see here, this is how our FICO scores are calculated. When it comes to our FICO scores, our credit scores go from 300 to 850. We get 550 points, basically to play with or to claim or to work toward. 550, and that's the cap, 300 to 850. Now, out of those 550 points, they're broken down into percentages and categories. The largest category is going to be payment history at 35%. That's 192.5 points of those 550. The next is going to be amounts owed. That's going to be your credit utilization with your credit cards and your loans. Your amount owed, that's 30% of your score. That's 165 points. Those are the two largest portions of our credit scores. And I'm going to go into more detail about each one of them. But I want you to understand these numbers. Write them down if you need to. 195.2. That's 192 points based off of payment history. Credit utilization, 165 points. Next is going to be our length of credit history. That's going to be our credit age. That's 15% of our score. That's 80. I want to say, yeah, I didn't do the math. Hold on. And don't get me, because it's two numbers and sometimes I get them mixed up. You know, I have a lot of numbers going back and forth in my head all day. It's not going to take me long. I'm going. 82.5 points. Credit, the length of credit history, that's going to be our credit age, the average of all of our accounts. 15% of our credit score. 82.5 points. Our next two, or the final two, both are 10% of our score, which is 55 points. It's going to be our credit mix and new credit. New credit is going to be opening new accounts and our credit inquiries. Those are 55 points apiece. Now, let's break this down. Payment history, 35% of our score. Your payment history is going to include positive payment history and negative payment history. Positive payment history are going to be accounts that you have opened in the past or accounts that you have opened now that are reporting positive payment history each month, helping you to build credit. If it's a car note, student loan, if it's a mortgage, whatever it is, positive payment history. That will help you to gain access to some of those points in that category, positive payment history. Now, late payments, charge-offs, and collections also affect your payment history category. So, if you have collections, charge-offs, and late payments, any recent derogatory accounts, you want to try to recover from those, or if they're reporting inaccurately, get them removed from your credit reports, or try to reach out to the lender if they aren't reporting correctly. If you have late payments, make sure that you were actually 30 days late. If it's a credit card and you were late, you have a 30-day late payment, make sure you received your statement within 21 days before your due date. They have a certain amount of time to make sure you receive your statement, your credit card statements. So it's just different things that you'll need to look for. If you can't find an error and you were late, you know you were late, it's reporting correctly, or maybe you tried to get it removed and you couldn't. If it's inaccurate now, you can reach out to the CFPB or your state. Your state may have a department just for debt collectors or debt collector complaints. You'll have to Google it. But you can reach out to the creditor if it's a late payment and it's yours, and you can ask for a goodwill, or you can challenge them. If you have 30-day late when it comes to purchasing a home, you guys, sometimes a lender will not want to see any late payments within 12 months. Some lenders may not want to see any late payments within 24 months. It's just going to depend on the lender. So you're going to want to make sure that you're paying all of your accounts on time. You're not getting any new recent derogatories. And if you have charge-offs and collections on your credit report or reporting, you need to get those taken care of. If you have charge-offs and collections reporting, if you want to pay an account, and I'm just being honest with you, you should pay the charge-off account, because the charge-off still has the possibility to be sold to a third-party collection agency and put another ding on your credit report. Now, I'm not just saying go out and pay charge-off accounts, because before you pay a charge-off account, you need to make sure that you're still responsible for that account. You need to make sure that you're still legally responsible for that account in your state, that is still inside the statute of limitations. You also need to make sure that that account is reported with maximum accuracy with the credit bureaus. So I'm not just saying pay them, but if you are going to pay some accounts, start off paying your charge-off accounts first, especially if they are credit card charge-offs and they are closed accounts, closed credit card accounts, still with a balance that's reporting CO every month. If you want to pay an account off, that should be the first account that you pay off. Got it? Got it? Good. Okay, now, before you pay a collection, and I tell this to anybody, always ask for validation. Always refuse to pay and ask them to cease all collection activities until they have validated this account with you per the Fair Debt Collection Practices Act, the FDCPA. That is your legal right. Now, that is going to be important, you guys. No recent derogatories. You do got some late payments. Make sure you're 30 days late. Make sure this credit cards, they follow the laws. You can ask for a goodwill. Sometimes when you do request a goodwill, it does take the lender longer to respond because they are giving you a goodwill. When I first did a goodwill, it was for Allie. It was on an auto loan. And it was for like 2 or 3 late payments. They sent a letter, but it took them like 2 months to do it. But I couldn't rush them because it's a goodwill. They're doing that out of the kindness of their heart and because I asked them to, because they didn't have to. Okay. Now, next, it's going to be our amounts owed is 30%. That's basically how our credit cards, and how we handle our credit cards. It's going to be our balance compared to our open debt, or our open credit. Our debt compared to our open credit. For example, if you have a credit card, say your credit limit is $500, you should make sure that with your credit cards, it never reports more than 30% of your credit limit to the credit bureau. So that would be $150. And now, listen to me good on this. 30% is just going to be your safety net. Your safety net. 10% should be your goal. And I'm saying that because with my credit card balances, when my credit card balance was under 10%, my scores were in the high 700s. When my credit card utilization went to 15 to 20%, my scores dropped like 10, 20 points. When my credit utilization went up over 20% to 20 to 25%, my scores dropped another 10, 20 points. When my credit utilization went over 30%, when it went to 37%, my scores dropped 72 points. So your credit card balances compared to your credit card limit matters. Remember, try to keep your credit card balances as low as possible. That doesn't mean you can't use them. But if you use your credit cards, you need to use them responsibly, and you need to have the money set aside that, or where you can pay that card off. With your credit cards, we always want to make sure our balance is under 10% on our statement end date. If you look at your statement from your credit card, there's going to be 3 dates. You're going to have an open date, and a close date, and a due date. With your due date, you always want to make sure you've paid your credit card bill by your due date and your account is zero balance due. But you also want to look at your statement end dates, because whatever your balance is on your statement end date or your closing date or your ending cycle date, that is going to be the balance that's reported to the credit bureaus. And remember, we want to keep that balance at 10% or less. That is the goal. 10% or less. 30% is satisfactory. 10% is the goal. Okay? Now, I've read on my Fico that loan amounts are factored into this as well, but I haven't really seen a big score increase or decrease, or I haven't noticed it over the years. So I normally just say credit cards and credit card balances, but your loans are too. But if you're going to pay something down or pay something off, you have open credit cards, that needs to be the first thing you pay off or pay down. Pay them down under 10%. And then if you have charge-offs, then you will pay them off. Collections should be the last thing that you pay off, and your goal should really be not to pay a collection account off, because no one told them to buy that debt. Like, no one told them to do that. And we need to make sure that they actually own that debt, because I've had people contact me and they paid the same collection more than once to separate collection companies. So y'all just be careful. If you feel comfortable with it, though, I'm not saying don't do it. Go ahead. But I just always suggest requesting validation first. And I'm going to leave the link to a letter here that you can use to request validation if you have some collections on your credit report. And you can also use this letter if you receive a collection letter in the mail from a collection agency, because you need to respond back. Whenever you receive a letter in the mail from a collection agency, we don't ignore those letters. We respond back and we let them know, hey, I don't know what this is. I refuse to pay this. Cease and desist all collection activities until you validate this account. Most of the time, I know more than 50% of the time, they're going to stop collection on that debt and they're going to take it off your credit report if it's reporting on there, because they're not going to have the information that they need to legally be collecting on that debt. Now, the next part, you guys, is going to be our age of credit. That's going to be the average of all accounts that we have open from the time that they've been on our credit report. With our average credit age, if your credit age is under, I'm going to say 7 years old, you have a young credit age. Anything over 10 years old, that's getting, a little better in average. But you're going to need more than 1 or 2 years of credit age. That's 88 points. That's 15% of our score. So you're not going to be needing to open and close a lot of accounts. If you have credit cards open and you don't want to pay them off and close it, leave them open. With your loan accounts, yes, if you can pay it off to avoid some interest, that'll be a good thing. But say like some of the small loan companies, a lot of the time they always ask you want to renew your loan, and they'll close off your old loan and open up a new loan. You guys, that's not healthy for your credit report, and it's most definitely not healthy for your credit age. That kills your scores. That tanks your scores. Those people may tell you that that's good for your credit score, or it'll help your credit, help you build credit. But next time, ask them how, because it's not helping you in your credit card utilization on your amounts owed. It may help you build a little payment history, but it's killing your credit age. And it's not going to be helping you build a lot of payment history 1, 2, 3 months. That's killing your average credit age. So if you are in a tight and you need those loans, go ahead and get it, but pay it off. Don't keep renewing it. because it brings down your credit age. Also, if you're in the process of getting, well, when I was in the process, let me back that up. When I was in the process of getting my home, my lender looked at my credit reports and he actually asked me why was Security Finance, World Finance, and One Main showing on my credit reports. Why could I not go to my bank? Because I had gave him paperwork to my bank, Wells Fargo. He said, why couldn't I go to my bank and get a loan? He said that he could deny me for going to those places to get a loan, not being able to go to my bank, because why couldn't they fund me? He was like, did your credit just get fixed or something? Like, what's going on? He said he could actually deny me for that. So we want to be careful when we get ready to purchase a home about going to all those different places. Also, when you get ready to purchase a home, you can't purchase a home with loan money or with credit card money. So you're not going to, if you go and get a loan, because I got a loan like 60 days before I purchased my home. I got that loan because I had consolidated some of my debt and I needed to pay my credit card balances down. Remember, if my credit card balance was down under 10%, my scores would jump up like 50 to 100 points. And then I had a repo with Capital One. It was $13,000, but we settled for $1,300. So I had to get a loan for that. Now, they wanted to see where my down payment was coming from, where my earnest money was coming from, like where all my money was coming from, and what did I do with the loan money, because I couldn't use that loan money. So I actually had to show them where I took that loan money and consolidated my debt and where I had my other money for my home in my savings account or in my account getting, for 2 to 3 months. So you want to be careful getting a loan right before you get a home, because they're going to want to know what you did with that money, because you cannot use that money to purchase a home. And this is hint, the only business credit is the only thing that doesn't show up. And I'm moving on. Okay, new credit. That's going to be credit inquiries. And remember, we don't want to open up a lot of new accounts neither. But credit inquiries are worth 55 points. When you start getting more than 2 inquiries reporting, they hurt your credit report. Credit inquiries over 12 months old are no longer factored into your credit score. So they are no longer hurting your score, but they can still be hurting your profile and cause you to get denied by a lender if you have a lot of inquiries reporting. Now, with inquiries, if they are attached to an open account, you never want to dispute them. When you dispute inquiries, you are basically, or the credit bureaus are basically removing them because of fraud. They're saying that you said you didn't do them. So if you're disputing an inquiry that's attached to an open account, they can close your account because you're saying that you didn't do the inquiry for fraud. So the account, doesn't belong to you. Also, when you are searching for a home or a car or student loans, there is this thing called rate shopping. With rate shopping, you can, for a specific amount of time, depending on which FICO model or which scoring model, Vantage model that we're using, they're going to calculate it differently. All inquiries that you do when you get ready to purchase a home, an auto loan, or get student loans within a 15 to 30-day time frame, depending on which credit scoring model you're using, all of those inquiries will be calculated as one inquiry. That's called rate shopping. Now, each inquiry will still show on your credit report, but that when it comes to your credit score, they will only be factored as one. The credit bureaus, Equifax, Experian, TransUnion, they call it rate shopping. They say that they cannot, they don't want to hurt you for going around doing something smart, which they say it is smart to be looking for a better interest rate. So they're saying you're out looking for the best interest rate for your, for your account. Now, rate shopping, all of them are calculated as one, but they do still show on your credit report. And you guys, I'm going to say one more thing about inquiries, and then I'm going to get it moving. With your inquiries, you can call the credit bureaus, especially Experian, and they will you have to get transferred to the fraud department. You have to let them know that you've already contacted the creditor, and the creditor told you that you had to contact the credit bureaus, and you need to let them know that you already got an identity theft report stating that the inquiries aren't yours and you get that report from identitytheft.gov, you will let them know that you spoke to the creditor and yes, you do have your identity theft form, because you're going to go to identitytheft.gov first. And you're not going to put any account information, but you're going to list those inquiries that you did not give your permissible purpose for. You're going to list those inquiries there on identitytheft.gov on that form. You're not going to list any account information. You did not give your permissible purpose. With that, with your inquiries, if you have an identity theft report, it's FCRA 605B. They have to remove those inquiries within 5 days. So you can call Experian. Most of the time, Experian will remove them right over the phone within 24 to 72 hours. If you go ahead and get the identitytheft.gov report and you call Equifax and Experian and they ask you, have you talked to the creditor? And you let them know, yes, I've already called the creditor. The creditor told me that they did, they can't put it on there. They don't know where it came from, that I needed to contact you. And you also let them know that, you didn't fill out a police report, because you don't know anything about that, but you did fill out an identitytheft.gov report, and they'll ask you what that number is that's on your report. And Equifax and TransUnion, they will go ahead and remove those inquiries for you over the phone if you have that paperwork. If you don't have that paperwork and if you want to keep hanging up, calling back, trying to find a representative who will be nice enough to just take them off, have at it. But if you go to identitytheft.gov and fill out that form, don't list any account information, only list those inquiries, follow the directions on the form, you can get those inquiries removed within 24 to 72 hours. Next, and finally, it's going to be our account mix. That's 10%, 55 points. You guys, with our account mix, remember earlier, I was talking about a thin credit file and you need multiple accounts open. If you have less than 5 accounts open, most lenders are going to say you have a thin credit file, and that can cause you to get denied. When you are building credit, or most people that have a strong credit profile, they have multiple accounts open and they have multiple different types of accounts. But if you're just starting to build credit, you need at least 5 accounts open. And this is what I tell my clients. We need 3 credit cards and 2 loan accounts. 3 credit cards can be a gas credit card, a store credit card, Visa credit card, MasterCard, Discover, any kind of bank card. But we need 3 credit cards, and we need 3 different types of credit cards to show lenders that we can handle different types of credit. With our loans, we're going to need a short-term installment loan and a long-term installment loan to show lenders that we can handle different types of credit differently. Short-term installment loans are going to be anything under 24 months. Consider anything under 24 months or a short-term loan. For our long-term loans, those are going to be 3 years or older. Okay, now let's go on into our Fico versus Vantage. Okay, these are going to be Credit Karma scores here that we are seeing on the screen. Remember, I told you I was going to let you know how you can tell what it is every time you see an account. You see the score here, it says 713. But we look under here, it says calculated using Vantage Score 3.0. Whenever you see your credit score, if you look underneath it, it should tell you which model they are using to calculate your credit score. And just remember, lenders do not use our Vantage scores. These are for educational purposes only. These are the scores: Credit Karma, Credit Sesame, Credit Wise, just the different credit monitoring. Look under your score. These scores here, Vantage Score, educational purposes only, you guys. Next, and also now, if you're looking under your score and it says FICO 800 or FICO something, that's the model. These are all of our FICO scores, you guys. Remember I told you there were more than 28, and these aren't all of them. We also have a FICO 10 and a FICO 10T. That FICO 10T, I'm not going to really get into detail with it, but it is for, it's FICO 10 trending, and that basically affects your credit utilization. I told you can pay your credit card balances down under 10% and your scores will jump up 100 points. if someone is using the FICO TNT, that doesn't work. They're going to be looking at all the time frame. Like they're not just going to be looking at, I think it's last 2 years too. They're going to be looking at how you keep your balances over the last 2 years. So you can't just pay it down and get a credit score increase with that FICO TNT. But if you see here, you guys, FICO 8 score. You see it says mostly wide used version. Used for your credit cards and different things like that. I think you can see those scores on Experian.com. On Equifax, I want to say those may be your Vantage, and TransUnion may be your Vantage, but I can't remember. Just look up underneath the score and it'll tell you. Also, when you apply for something and they send you the letter in the mail, if you get denied, on the back of it, they'll tell you, which scores they used and which credit model it was as well. See, here we have auto lending scores. These are scores that are used when you go to the car dealership. Your bank card scores here, your Visa, MasterCards. Remember we said we're going to talk about what lenders use for mortgages? When you go to get a home, versions used in the mortgage lending. Lenders use your FICO 2, your FICO 5, and your FICO 4. Those are the only scores that they use. And lenders, I think, are just about the only people who do use them, or they're only used for mortgage lending. And those scores are different. You see here on the bottom, these are just newly released versions. It doesn't have the TNT and the FICO 10 and the FICO TNT is not showing here, or it's not reporting here, but they have them as well. Remember, the mortgage lenders are going to be using our FICO scores, FICO 2, 4, and 5. Now, if you would like access to your mortgage scores, you can get those from myfico.com. You can also get them from credit.com. If you look in the description, I'm going to be leaving some links for you guys where you can get straight to them. I've actually found my, credit.com. They give them to you. They give you your scores cheaper. They give them to you for $24.99, and they give you all 28 of them. That sounds better, right? It sounds better than $39.99. But I like my FICO because that's what I used when I was getting ready to get my home, you guys. But you'll have both of the links, and you can decide or choose, for yourself which one you want. Okay, negative information to review on your credit reports. Now, first thing we need to do is get access to our credit reports. We're going to review those credit reports, and we're going to make note of any inaccurate information that we see. And when we start looking for the inaccurate information, you guys, we're going to start with our personal information. And we're starting with that personal information because we want to remove any old, outdated, or excessive personal information, or inaccurate, incomplete, whatever. You only need one name reporting. We only need one address reporting, preferably your most current address that's not tied to all of those negative accounts. And that's because all of your personal information, you guys, they have a little code attached to it. And that code is attached to different accounts. If the account information matches that name, or if the account information matches that address, those codes are going to be tied together. So if we can get rid of the source, which is the personal information, that'll get rid of the codes being attached to the personal information. And the credit bureaus actually have to do a real investigation. They actually have to verify information instead of just matching information or playing match with information that's already on your consumer reports. Now, one name, preferably your name, your first name, middle name, last name, and it needs to be the same across all bureaus. One address, you guys, preferably our most recent address. Remove all those old addresses to make sure the spelling is correct, zip code, the numbers, everything. We don't need any employers. We don't need any phone numbers. We're going to remove that information. You also want to review your date of birth and your social security number. You would not imagine how many times I looked at a credit report and the date of birth is a year off, social security number is a digit wrong or off. Review that information, because having that negative information on your credit reports can cause your credit file to get mixed if it isn't already mixed with someone else's information. Okay? I hope you got that now. Okay. Next, gonna be charge-off and collections. If we have charge-offs and collections, if y'all have those reporting on your credit reports, I'm gonna say this. You can get approved for a home with negative information reporting on your credit reports, but will you get approved with the best interest rate? No. Will you get approved for the most home that you can get approved for? No, because it's going to be affecting your credit score and your debt to income ratio. So if we have charge-offs and collections, we need to take care of those. If you have charge-offs, ask for verification. Contact the original creditor. Ask them what information they have on file. Compare that to the information that's reporting on your credit report. Make sure that account is reporting accurately. Make sure the original creditor has the information that they need. And when you're disputing charge-offs and collections, you need to be disputing or challenging with the credit bureaus or the consumer reporting agencies, whoever you call them. And you need to be disputing with the creditor, your original creditor, the third-party collection agent, whoever is reporting it, the furnisher of information. You need to be disputing with both of them. We don't just dispute with the credit bureaus, because if you're just disputing with the credit bureaus, you're not going to get the results that you're looking for. Now, remember, if we have charge-offs and collections reporting, we always pay the charge-off first if we're going to pay something, especially if it's a credit card, because that will help us with our credit card utilization. You have a charged-off credit card reporting, it's hurting your average credit utilization. That 30% category that we looked at is bringing down it's taking up your credit usage. So if you have a charged-off credit card that's still with the original creditor, make a settlement and pay that off first. After you've paid it, you can get it removed. If you want me to tell you how to get charged off credit cards with a $0 balance removed from your credit report, let me know in the comments and I'll make a video for it. But if you read your credit card contract, you can figure it out. Just read your credit card contract. Okay, charge-offs and collections, and remember, we need the collections gone as well. If it's with a third party, make sure we're asking for validation. Now, if you have, I'm going to say a repo is going to be considered a charge-off or a collection. You will handle it the same way. Now, I've had a client to actually get approved for a home with a repo on their credit report, but their scores weren't as high as they needed them to be. I'm sorry. Yeah, their scores weren't as high, so their interest rate was higher. And they also couldn't get approved for as much as a home that they wanted to. Me, I couldn't get approved with a repo on my credit report. I had to make sure that account was paid. It didn't have to be paid in full. The balance just needed to say zero. So that's how I ended up making that settlement with Capital One, because it had to be paid. Remember, if the charge-off account is closed and it has a balance, and we want to make a payment, we want to pay that first. We want to pay charge-offs and our credit card balances down before we pay any collection. Next is going to be late payments. Remember, we have to pay all our bills on time. We can't get any new recent derogatory accounts. Lenders do not want to see any recent late payments, because if you were just late last month, what makes them think that you are in a financial position to pay a mortgage this month or a couple months ago? You have to be careful. No recent late payments, you guys. Now, the next thing we're going to be looking at going to be those public records. With public records, before I even say this, I want to say something else. Anything that's on your credit report can be challenged or disputed to be deleted or removed from your credit reports. Information that is removed, if it's still inside of the statute of limitations, you still are legally responsible for that debt. Now, with bankruptcies, liens, federal student loans, evictions, foreclosures. If these accounts can be removed from your credit reports. And if they are removed from your credit reports, lenders can still see these accounts. Your bankruptcies are public records. Child support is public records. If you're in behind on child support, liens, judgments, those are public records. Student loans, they're going to be looking at your CAVERS report. That's going to show what your status is if you're in default with your student loans. They can still see evictions. They can still see foreclosures because that's public information, you guys. So even if that information is removed from your credit reports, it can still be found. If it's a bankruptcy, your bankruptcy, depending on which kind you have or what's in your bankruptcy paperwork, you have to wait a year or 2 years to apply for a home after you complete your bankruptcy. So even if it's removed from your credit report and you're trying to get the home before the time that's allotted, the lender can still see it and find it, and you can still be denied. With bankruptcies, if you're in a Chapter 13 bankruptcy, you can get approved for a home while you have been in Chapter 13. If you have been in Chapter 13 up to 9 months and you have been making your payments on time, you can get approved for a home while you are in Chapter 13. But if you wait until your Chapter 13 has been discharged or completed, you will have to wait a year or 2 years depending on what's in your paperwork before you can apply for a home, or depending on the lender qualifications. I spoke with someone the other day. They told me that one lender told them it had to be 4 years before they could apply after they finished bankruptcy for, a loan with them. So bankruptcies can still be found. Defaulted student loans can still be found. If you have defaulted student loans, if they are federal, you want to see if you can make a rehabilitation, or if the lender or if your student loan provider offers rehabilitation. If they are federal loans, they should. With private student loans, they don't have to offer that. But if you have federal student loans, you need to get with them if your accounts are in default and try to get those rehabilitated. Rehabilitation is a 9-month program, and it can only be done once in your lifetime with your student loans. With your student loans, if you do get rehabilitation, the payments will be dependent on your income. Most of the time, those payments are $5 or less. If they are private student loans, you will handle them just like you handle charge-offs and collections, depending on their status. With federal student loans, if you're in a hurry and you don't want to wait 9 months, if you can get your student loans consolidated, that will get them out of default status, and it'll start you some new loans, or new accounts with all of your loans bundled together, so you can move forward with the process. Now, if you do consolidate your loans, the reporting of default will remain on your credit reports, but if you go through rehabilitation, they will remove the remark of in default. So if you have time and you have student loans in default, do rehabilitation if they are federal. If they're private, you can make settlements, charge-offs, you can dispute them just like you do with regular charge-offs and collections. If evictions, foreclosures, if they still have a balance, you're going to have to get those taken care of. Even if you're trying to rent a home and you have an eviction, most of the time an apartment won't let you rent there until that balance is taken care of from your previous eviction. You have to get that balance taken care of, because they don't want, a landlord doesn't want you to leave them with the balance either. So that can get you denied. You're going to want to take care of those balances. Even if they aren't reporting on your credit report, they can still be found. Just remember that. Inquiries. We don't want to be getting excessive inquiries when we're getting ready to purchase a home, and we don't want to be opening and closing a lot of accounts unless you don't have the minimum accounts open and you're trying to build credit, and you have at least 6 months to let those accounts get seasoned and start building credit history and reporting positive payment history for you. But other than that, you don't want to get a lot of inquiries. And remember, I just told you guys how you can get those inquiries removed from your credit reports earlier. Now, If you guys, I also have a complimentary information to clean up your personal information. You can scan this if you would like to get access to it. And I will also be putting the link to the personal information clean up letter in the description. Okay. Your debt to income during the home buying process. You guys understand this is very, very important. Your credit score, and your credit profile is not the only factor when it comes to getting your home. Your credit score and your credit profile will be used to determine if you are essentially approved for the home, but your debt and your income will determine how much of a home you are approved for. You guys, I also forgot to mention this to you earlier. Remember, I said, I showed you the Fico scoring, where lenders will be looking at your FICO 2, your FICO 5, and your FICO 4. Now, they're going to be looking at all three of those scores. But when it comes to determining the score that's going to be used to see if you're going to be approved, they're going to use your middle score. For example, if you have a 600, a 650, and a 700 credit report showing, they're going to use the 650 because it is your middle score. It's not your highest score, and it's not the lowest score. It's your middle score. Not the highest, not the lowest, but your middle. They're not taking the average or anything, you guys. They're looking at all three scores. You can mark off your highest score, mark off your lowest score. They're going to be using your middle score. Now, that's going to determine if you're approved, your score and your profile. Your income and your debt is going to determine how much of a home you are approved for. You can also be denied if you have too much debt and not enough income. There is a certain percentage that you have to be at. And I don't even want to quote percentages. I'll say when I did mine with my home and my previous debt, all of it together, even my mortgage loan note, it had to be under 44% of my total income. So, but it's going to depend on your lender as well. So if we're having those, we got some debt, the collections, the charge off, we got some high balances on loans or installment loans that we can pay off. I would do that. If your credit card balances are high, get them under 10%. Not only does that help with your scores, not only does that help build a stronger credit profile, you guys, it can give you access to more money. It can give you access to a larger amount of a home. It can give you more of a home. You can get qualified for more. The less debt you have and the more income that you have. Debt. If you have any debt, current or past, we want to pay it off. We want to pay, well, I'm not going to say off, but we want to pay it down, and we don't want to get any new debt. If you have some past debt, those charge-offs or collections, we want to take care of those. If you have current debt with your credit cards, pay your balances down under 10%. Rule of thumb for me, every 3 credit cards I have, because all your credit cards don't need to have a balance unless you only have 1 or 2. When you get to having 3 credit cards, only one of your credit cards need a balance. And for every 3 credit cards, I let one run with a balance. And I try to move those around so that my accounts don't get closed for not being used. But for every 3 credit cards you have, try to only use one and let one credit card carry a balance out of every 3 credit cards that you have. We don't want any new debt, you guys. Don't go get a car before you get your home. Don't go get the furniture before you get your home. We have to wait on that. That's giving you more debt. And the more debt you have, the less of a home you can get. You guys, you have time after you leave the closing table. You have 30 days before your new mortgage will appear on your credit report. So you have time to go get your car after that. I've had clients to get approved for their home one day and go get approved for their car the next day. And then they'll get their furniture. You know, you have to get the most important thing first and the biggest amount. So we're going to get our home first, then we'll do the car, and then we'll do the furniture if we need to. Remember, I told you guys, like I have a lot of student loan debt. Like I told you, I have so much student loan debt. I didn't think I would ever be able to get approved for a home. At the time, I think I had $60,000 or $80,000 worth of student loan debt when I got ready to get my home. I was able to get my home on my own, and I was only making $44,000 a year. And I was approved for $150,000. There's a possibility I could have been approved for more, but I did not do this process right. I looked for a home first and then I went to do the pre-approval. I should have gotten pre-approved first so that I knew how much home I was actually approved for, because I still don't know to this day. For all I know, I settled. I could have got more of a home or a bigger home, but I'm not complaining because I'm happy and I'm blessed. And this is my first home. It's building equity. I'm not giving money away. I can always sell. But we want to be careful. No new debt. Pay our old debt down and our current debt. You guys, also budgeting and saving. Budgeting and saving are also a part of the credit risk restoration process. It's going to be a part of the home buying process. You're going to need to have savings put away for a down payment. You're going to need to be budgeting so that you're saving money and that you know how much money that you have to spare for a mortgage or how much mortgage you can comfortably afford. Budgeting will help you to be able to decide that, because we don't want to get in over our head. Budgeting will also help us save, because even if you get approved for a no down payment home, you may also still have other fees to pay for. You're going to have to get your home inspected. You may have to have earnest money. You may have to have extra money set aside as well. You know how it is when you want to think of a word. I can't remember it right now. Reserves. That's it. You may need reserves put aside. Like, you're going to need some form of money. Even moving expenses, getting your utilities turned on, just different things like that. So budgeting and saving is going to be an important part of this process. It can't be skipped either, you guys. Credit building. Remember, we talked about we need at least 3 credit cards. We need a store credit card, a bank credit card, and gas credit card if possible. With our credit cards, yes, they say 30%. You should keep your credit balances under 30% of your credit limit. But remember, the safety net is 10%. When I read on my Fico.com that high Fico score achievers with a credit score of a 760 or higher have an average credit utilization between 6 and 7%. So you guys, that's why I say just keep it under 10%. 10% should be the goal. 30% is the safety net if you have an emergency. And you guys, think about it like this. When your credit card balances are low, your credit scores are high. If you come into an emergency and you know you're not going to have the money available to pay that balance down by the time you get to your statement end date, I would rather take a hit on account age if possible, because I would rather open up an installment loan, get a loan from somewhere, and just pay that loan back and keep my credit card balances down so my credit scores won't waver so much, or so I won't lose so many points. You guys, going over 30% of my credit utilization, I lost over 100 points during that process. So we want to keep our credit card balances low, and we do need a credit card. If you don't have a credit card, you're going to have to open up a credit card. I know you may be getting denied if you're just applying for things, but that's because your scores are low. What you're going to have to do is secure your own credit card. You're going to have to back your own credit card. If you say you bank with Regions or Wells Fargo, you want to make sure you got between $200 to $500 in your savings account, depending on your bank. And you can get a signature loan, or you can get a secured credit card from your bank with the money that's in your savings account. I always say get a signature loan or a secured loan off the money in your savings account, and turn around and use the money from the loan to open up a secured credit card if you don't have accounts open, because that's killing 2 birds with 1 stone. You can actually 3 birds with 1 stone, because you're opening up an account, you're building a relationship with your bank, you're getting a credit card, and you're getting an installment loan. You're working on your mix of credit as well. So that'll help you build credit if you need to go that route. It's okay to secure your own lines of credit when you get started. And that's probably what you're going to have to do if you don't have anyone to co-sign for you. You guys, there's also, you can do self-lender. You can do Credit Strong. You can do Kickoff. Kickoff will report like a revolving credit card. And I'll put some links in the description to those sites as well. Those are just credit building sites. All of those sites are safe. I have used those accounts, or my clients have used those accounts, all three of them. And if you're gonna get one, at least get kickoff if you don't have a credit card, because it'll report like a revolving credit card. You won't get an actual credit card, but you can get points out of your credit utilization if you're getting denied for a credit card. I would open up kickoff and a secured credit card, but you're going to need a credit card open. And remember, you guys, we're going to need that mix of accounts, three credit cards, and 2 installment loans. The credit building process is one of the most important stages in the credit repair process. Although the credit building stage is one of the most important parts of the credit repair process, it is also often one of the most skipped steps, you guys. And it really is, because most of the time, 90% of the time, when I speak with someone and their credit scores are under a 700, they're under a 700 because they don't have a credit card, or their credit card balances are over 30%. So having a credit card and your balances are very, very important. Also, getting that debt down and getting rid of past and current debt, you guys. I got one more thing about the pre-approval process. If you make it to that pre-approval process, you guys, congratulations, and I'm going to be so happy for you, my future homeowners, especially if you made it this far. I have one more thing I want to say, because I've seen this numerous amounts of times. I've already hit on it just a little bit, but this is a major credit tip. When you get pre-approved for your home, do not open up, after you get your pre-approval, do not open any accounts before you leave that closing table. If you open up accounts after you get your pre-approval, it can change your pre-approval amount, because it's going to be changing your debt. It can also cause you to get denied. I've seen people almost lose their home because of opening a furniture account. I've seen people lose their home for going to get a car, and now they got to take that car back to the apartment. They can't pull it in that garage they wanted to, because they couldn't wait. And it's not their fault that they didn't understand the process. So it is a process, and you do have to be careful. When you get your pre-approval, don't open any more accounts unless your lender tells you to. And get your paperwork in order, you guys. Your ID, your taxes, your pay stubs, and keep all of this stuff current and up to date. You may have to give that information to your lender more than one time, you guys, but guess what? It's okay. We're asking them for a large amount of money, and they have to make sure everything is accurate, and they have to make sure everything is up to date. And it goes through different departments. So one department, may have it at one time, or one department may mishandle it or put it somewhere else, and they may need it again. So just keep all of your paperwork together. If your lender asks you for something, do not get frustrated. Do not give up on the process. Just give them what they asked for. My lender asked me for multiple things, multiple amounts of times, and guess what? I gave it to him with a smile the same day that he asked me for it. So, and I know he appreciated that, and I appreciated him. You guys, I would like to thank you if you made it this far. I hope this helped you guys. You guys, I'm actually working on a book to give you more detailed information, and it's called Highway to Home Ownership. It will be coming soon, you guys. I will be leaving a link in the description box for that as well, you guys, where you can subscribe to know when it will be released, and for any coupons and things like that on the book. If you have questions, please drop them below. I will be going through answering all the questions for you guys. I appreciate you watching. If y'all need me to break some more things down, explain this some more, you guys, you let me know. It was great. Thank you for joining me. Until next time.